Hey there, property navigators. Time and time again, we are hearing about markets that have previously offered strong yields in the 5 to 6% range that are now offering yields in the 4 to 5% range, and we keep getting the question, does it still make sense to buy there because yields have been pushed down? Well, today I'm going to examine the frameworks required to understand a market that has undergone significant recent growth, where yields may have fallen away due to recent price surges. I'll teach you the right strategies to allow these markets to still be targeted, especially if further rental and growth drivers are well entrenched. At the end of the video, I'll provide an example using the average of capital growth and rental growth of past performing markets to show you exactly what you could be missing out on by dismissing lower yielding areas. A lot of investors want the best of both worlds, to find areas of both strong yields alongside strong capital growth. While yield is important, the question lies, should you be discarding areas that have had historically high yields, but at present have yields that have been subdued? Our advice, don't get stuck in the short-term aspects of property investing. Take into consideration what an investment property could be producing in 12 to 36 months' time. The lower, more affordable brackets of the market are currently experiencing twice as much growth than the upper end of the market. With imminent price growth occurring due to demand, gross yields have been pushed down because although price increases in the rental market have been strong, they haven't been increasing at the same pace as capital growth. Now, it's dependent upon the strength of recent growth as to the impact on the suburbs yield. Typically, capital growth and rental yields have an inverse relationship, meaning as one moves up, the other will move down and vice versa. This isn't always the case. Some markets do experience strong capital growth and rental increases, but more than likely one is outpacing the other. When yield and capital growth are pushing up concurrently, it's normally capital growth winning the race. Now, watching yield recovery is an extremely effective tool. And let's take a look at an example. This graph on screen shows the rental yield for only 12 months, but can be a major piece of the puzzle when investigating an area's future potential. In June 2023, yields were below 5%, but then shot up to over 6% in December 2023. In 2024, these yields have been pushed down due to prices increasing in this location, and more are expected. This is why you can see the score of excellent in the top right-hand corner of this image. In this example, the historical range has typically been in the 5.2 to 5.6% range. With a vacancy rate of just 0.5%, it can be expected that yields will recover strongly into this bandwidth. If other data supports this type of location's positive growth dynamics, you could time your entry effectively by buying at the right time of the market cycle. We have a whole video on this, and the link is in the description below. As the market cycle progresses, growth accelerates and rental returns also increase, so yields can continue finding their benchmark or beyond while imminent price growth occurs. The result is a stronger return on invested capital in a shorter time frame, allowing you to plan your next investment property acquisition sooner. So, how do you confidently buy into these markets? The strategy here is to focus on much larger profits made on capital growth to offset the lower initial yields until they play catch up, before the cycle then starts again. This will put you back in the driver's seat for cash flow, which will increase serviceability, while equity builds for the next property portfolio purchase. This is what is referred to as forward planning your property acquisitions. If you plan to buy again in 2 years' time, you need to ask yourself, do you really need higher yields right now over much stronger capital growth? Or should you focus on an immediate overall return on investment, which factors in both growth and cash flow? Because more than likely, growth is going to be what gets you into your next property. In saying that, forecasting what the rental yield over the next 12 to 24 months could look like when you may be ready to acquire your next investment property is important. And by that point, your yields will have recovered to a forecasted level. For example, say that capital growth equated to $150,000 over 2 years, but cost you an additional $7,000 per year to hold, so $14,000 in total. Would you trade $14,000 for $150,000? Do I need to do it backwards?
No, it's fine.
No. Whilst capital growth and rental yields normally have an inverse relationship, or at a minimum, a difference in intensity of their movement at any one time, the drivers that direct their trajectory and strength of movements are controlled by different market pressures. So what are the main drivers of capital growth? Well, first off, we have demand, driven by affordability, demographics, connectability, interest rates, lifestyle, amenities, and incoming infrastructure plans, and there's plenty more. Number 2, supply, such as new developments and estates coming into the area. And number 3 is confidence in the market, which can be measured by the amount of loans being written, the physical number of buyers attending open homes, days on market, and overall inventory levels. Now, what are the main drivers of rental demand? Well, the first one is supply of rentals. The second one is population growth. Number 3 is disposable incomes. And number 4 is the cost of living pressures. With this knowledge of demand pressures, you can then research and determine the current and predicted future rental demand in a local government area or suburb. This can be obtained through looking at data such as increases to the population versus levels of incoming supply. For example, new estates, subdivisions, or developments all found on local government websites. By also researching a location's disposable income level, normally comparable from consensus data, you can get a fair understanding of what an area's demographics are like and if they are improving or not. This can give you confidence in the direction and magnitude of rental growth that can be expected. But remember, to factor in the impact of economic factors such as inflation and wages growth, which directly affects cost of living pressures, which can put a cap on the level of rent an area can demand at any one time. Check out the ABS Quick Stats to review a suburb's rental demand trajectory based on incomes, rental vacancies, population growth, and general demographics to ensure that these are good markets. In this next example, I'll show you what I mentioned earlier, the need to forecast. To effectively evaluate a property's performance relative to your goals is a learning curve, but you need to understand this as a DIY investor. Or give us a call. I'll be happy to run through this with you. In the graphs displayed on screen now, I'm going to take real data and apply it to an example using the average rental and capital growth of the top 3 performing markets of Brisbane, Perth, and Adelaide. And before people jump into the comments about only using the top 3 markets, if you're an astute investor, you should be buying into these markets, and for this reason, I'll be using these figures. Okay, so say you purchased a property in May 2023 for $550,000, renting for $490 per week, equating to a gross yield of 4.6%. We can now apply the average annual capital growth rate of 17.6% and the annual rental growth rate of 10.5% to see what the outcome may look like in May 2024 or 12 months later. Let's focus on rental growth first. If you multiply 490 by 52 weeks, this equates to $25,480. Now, let's apply the rental growth rate of 10.5% to this, which works out to be an additional $2,675 per year. The result is a yield now at 5.1% compared to the yield at acquisition of 4.6%. So pretty damn good, right? Now, let's take the annual growth rate average of these 3 states, which sits at 17.6% until May 2024, and apply it to the purchase price. If you multiply 550,000 by 17.6, this equates to an equity uplift of 96,800. And as you can see from this example, effectively timing a market that has yield subdued but has retained strong rental and buyer demand could see yields drive up incredibly quickly during recovery along with property prices. And remember, cash flow is important, but it means nothing if you don't have adequate deposits for your next acquisition. Now, it's important to circle back here, and I'm referring to markets where yields have been pushed down, but historically yields have been much higher. What could the outcome be if you dismissed a location with lower yields in preference of a higher yielding location with inferior demand pressures on the capital growth side of the equation? Using the previous example on a $550,000 purchase, say it returned only 8%, not 17.6%. At 8%, the equity gain would be $44,000. The opportunity loss here is $52,800 when compared to the 17.6% growth, which equated to $96,800. You may have missed out on $52,000. Don't do that. Especially when buying your first and second investment property, you need to ensure you achieve strong levels of imminent price growth over the short as well as the long term to repurpose equity into new deposits, as you'll probably be buying every 12 to 36 months while you're in the accumulation stage. If you want further insights into locations that are currently undergoing significant price growth, where yields have been impacted but are quickly recovering, then check out our video on the best properties to buy under 600,000 in Southeast Queensland. Until next time, happy property navigating.